Thank you very much for the invitation. This is a fantastically timely conference. As you know, the pandemic has really put government finances at the front of the policy response. And I think it's very appropriate that we look at sovereign debt and the implications for the policy response in the weeks ahead. This chart is from our annual economic report, which was published at the end of June. It gives you a sense of the initial round of fiscal responses, both from the advanced economies and from the emerging market economies. The red bars are the budgetary measures taken by each country, and the blue bars are the non-budgetary measures, such as guarantees and lending. And you can see that as a percentage of GDP, these are very large. So as a rule of thumb, as a proportion of GDP, advanced economies have injected around 10% of GDP in terms of direct budgetary support, and another 12% roughly in terms of guarantees and lending. The support in the emerging markets has been far smaller, but they've been large by historical standards as well. So roughly speaking, 3% in terms of budgetary measures and another 3% in terms of the non-budgetary measures. Now, of course, this is now a snapshot as of a few months ago. And there was a hope in the early stages that the pandemic would be short-lived and that we would be able to go back to the previous trend growth. What we're realizing now is that the pandemic may linger for much longer. And so the course of the global economy is going to depend very much more on the trajectory of the pandemic itself. As the previous speakers have pointed out, we see a very large fiscal deficits and very large increases in public debt. And these are some of the charts that we put on in our annual economic report. They are, really quite substantial, and this is really the only the beginning in many ways, because we will expect to see further fiscal measures coming through. One thing which has been remarkable is that in spite of the financial turmoil that we saw in March, emerging market economies have managed to loosen monetary policy. They have cut rates, and they have also engaged in sovereign bond purchases directly. It's not for monetary financing purposes, but more for market functioning. It's for orderly market functioning. But it's a very different approach compared to the usual playbook of emerging market policymakers, where in response to a sharp depreciation of the currency and very large capital outflows, we would normally see a sharp tightening of monetary policy. Now, what I want to do, and I have too many slides, is to focus on the notion of original sin. And as you know, this is a notion that was coined by Eifengreen, Hausman, and Panizza. And the idea here is that emerging market borrowers, if they want to borrow from foreigners, are somehow bound to borrow in foreign currency. In fact, that notion has been so deeply ingrained that whenever theorists in international finance write down models, they immediately reach for a currency mismatch assumption in their model. But in fact, that feature is very far from the truth. And as I put in the cover slide, the theme of this set of slides is how emerging market sovereign borrowers, so central government in particular, have managed to overcome original sin. Now, let me show you a few charts and give you a sense of how large the domestic currency debt is. This is just in terms of the dollar amounts at the end of last year. And you may know, for those of you who have been using the BIS debt securities statistics, that we publish our domestic debt securities statistics. And we do so on the basis of currency denomination and also on the sector. So these are taken from our debt security statistics for central government, and they show the amounts outstanding in billions of US dollars. So clearly it's the large emerging markets that are going to have the largest debt. And the two countries that really stand out here are China and Brazil. What I would point out is that foreign currency is in blue, and the rest is in domestic currency. However, a very important distinction here is between domestic currency debt that is held by domestic investors and domestic currency debt that is held by foreign investors. Let me use a different scale for the other countries. So for China and Brazil here, you should look at the left-hand axis. They are in trillions. On the right-hand axis are the 100 billions for the other economies. And you see that there is quite a lot of difference across countries. And it's best if I show you this chart, which is dividing the currency denomination and the holders of the sovereign debt in terms of the currency, which is in terms of foreign currency, which is blue, and the pink hashed region, which is the domestic currency bonds held by foreign investors. What you see here in this chart is that increasingly global investors, global fixed income investors, have been entering the market for emerging market local currency sovereign bonds. Now, of course, there are some countries where the currency mismatch is still important. I don't have it here because we didn't have all the data, but Argentina is a case where sovereign debt is primarily in foreign currency. But even in this sample, you see that there is quite a bit of cross-sectional diversity. But for many emerging markets, most of the sovereign debt is in domestic currency. And the proportion held by global investors varies, but the currency denomination is very clear. The blue parts are not very large. So one way you could characterize this is to say emerging market sovereigns have well and truly overcome original sin. So they can borrow in their domestic currency. Now, does that imply that emerging market sovereigns can insulate themselves from global financial conditions? And here the answer is no. So what I want to do is to take you through an argument that says there has been a shift in the currency mismatch from the borrower's balance sheet to the lender's balance sheet. In other words, for the global investors, their returns are measured in dollars, euros, or yen, but they tend to hold the emerging market sovereign bonds on an unhedged basis. So let me illustrate that with the notion of duration. So duration, as you know, is the ratio of the percentage change in the price of the bond to a small change in the yield. So this is a theorem, but the basic definition is the duration is the weighted average of the dates of the cash flows that come from the bond, where the weights correspond to the proportion of the present value that is due to the payoff at that date. So, for example, if it's a zero coupon bond, then the duration is exactly the same as the maturity, because all the payoff comes right at the end. For a coupon bond, we would tend to see the duration be shorter than the maturity. But duration is a market price, is itself a market price. It tends to measure the sensitivity of the return of the holdings of the bond to a shift in the yield. Now, the crucial point here is that you can measure the return either in local currency terms or in dollar terms. For domestic investors, they would care primarily about the return in local currency terms. For global investors, they will care about the returns in dollar terms or in other hard currency terms. So let's do some very high-level empirical analysis and plot using weekly data the percentage return on the price of the bond to yield changes. Now, return and yield changes, they are negatively related. So we will tend to see dots in the top left-hand corner or the bottom right-hand corner. And this is exactly what you see here for Mexico and South Africa. So the blue scatter chart is the relationship between the change in the yield and the change in the local currency return. The red dots are the relationship between the change in the yield and the return in US dollar terms. And what you see is that the red dots are steeper than the blue dots, which is to say your return is much more sensitive in dollar terms than it is in local currency terms. Now, the way that we have defined this, the slope of this line is the duration, because it is the return divided by a small change in the yield. So we see that for the blue dots here, the blue dots have a slope of 5 years, which is to say these correspond to bonds of roughly 5 years or more maturity. And that's exactly what we would expect from this index. It's the JP Morgan index of the principal return. And they are typically of bonds between 5 and 7 years of maturity. Now, if we look at the red, it's much steeper. The slope is 12.4. So what this says is, if you are calculating returns in US dollar terms, it is as if you have a much riskier bond. It's as if you have a bond which is 15 or 16 years maturity. The same is true of South Africa. Here, the slope is 12.8 in dollar terms, whereas in local currency terms, the slope is 4.59, again, which is very consistent with the JP Morgan return index. Let me also show that this is not a phenomenon just for those two countries. Here's Indonesia and Brazil. You have the same phenomenon. Now, what could account for this particular correlations? What it means is the exchange rate will co-move with the yield in such a way that it amplifies the gains and losses if you are evaluating your returns in US dollar terms. What that means is during capital inflow periods, for example, let's say that you're here where the yield is falling. This is a region where financial conditions are accommodative. This is a region where bond yields are falling. Credit conditions are more accommodative. And this is the region where dollar returns are higher than the local currency returns. In other words, this is a region where the US dollar is depreciating vis-a-vis the local currency. So during an inflow period, this is a time when the currency of the emerging market is getting stronger relative to the US dollar. So that's a kind of weak US dollar phase. And during a weak US dollar phase, you would have capital inflows, you would have yields falling, and then the dollar investors are gaining both from the currency movement as well as from the change in the price of the bond. Of course, the mirror image of this is that during stress periods where the yields are increasing, you have exactly the opposite. In other words, it's when the dollar is stronger, you have dollar returns being lower than the local currency returns. So this is a very familiar feature of any global fixed income investor who will tell you that when you invest in emerging markets, you have to time the entry and exit in such a way that you capture the left-hand part of the panel when you have capital inflows, a weaker dollar, and a risk-on environment. And avoid those periods on the right-hand side, which is the risk-off period. Now, what I want to show you is that, in fact, during this crisis, we saw this playing out at least during the March period. So if we look at the, I'm going to show you some charts from a bulletin piece that we published at the end of March. It's showing the capital outflows. It's the bond fund flows into mutual funds and ETFs on the left-hand side, and the correlation between the dollar and the bond spreads on the right-hand side. We see the bond spreads and the dollar moving in lockstep, just as you have the capital outflows, as you would expect. Now, the key here is the sensitivity. And what turns out to be crucial is the proportion of the local currency bonds that are held by global investors. And in this respect, the left-hand side panel is going to be very important. The yellow is emerging markets more broadly. The blue is the Asian emerging markets, and the red, so the yellow is the non-Asian emerging markets. And what you see is on the right-hand side, for those countries that have had a larger foreign holding, you have a bigger increase in the yields. And that, in a way, makes very good sense, because if you're a global investor, during these stress times, you know that exchange rate depreciation of emerging markets will tend to amplify the losses that come from the yield increase. And it's a very natural step for you to reduce your exposure to that emerging market. The downside, of course, is that from the emerging markets point of view, this means that they are subject to the fluctuations in global financial conditions, even though they have overcome original sin. So let me just, I've got a phone call. Let me just, okay, just sent a text. Okay, so what can we learn from the recent episode? Well, we see that in this March period, we see exactly this correlation between the dollar and the returns on local currency bonds. And from a policy perspective, it does raise the question, how can emerging market sovereigns manage to insulate themselves from global financial conditions in a better way than they have so far? The issue is that for many emerging markets, the bond market is still rather shallow. The domestic investor base is relatively small, so there is a higher reliance on foreign investors to absorb some of the new issuance. I think here we circle back to the monetary policy response this time round. I think what's been very interesting this time round is that emerging market central banks have managed to react to the financial stress with more accommodative policy. Now, what that means in particular is that rather than reducing fiscal expenditure, the central bank may come in and help with the absorption of the new bond issuance. Now, of course, the danger would be kind of fiscal dominance, where monetary policy is subordinated to fiscal policy. And I think this is something that emerging market sovereigns are extremely aware of. And I would say that one of the reasons why we see the fiscal response being so much smaller in emerging markets is precisely the realization that the dangers of monetary financing is something that emerging market policymakers are very well aware of. Nevertheless, what this means is that the policy response is going to be constrained by the ability of the sovereign to accommodate fiscal expenditure along the way. So let me conclude by saying that what we have been working on is to think about the policy response of both the advanced, but especially the emerging markets in this particular period. And focusing on how fiscal policy and monetary policy, together with financial regulation and the financial system, all need to be taken on board at the same time. So let me conclude there.
Professor Marlene Armstead, and Marlene is a leading scholar in terms of debt issues. As I mentioned, she and Professor Zhi Guoqi from Chicago wrote an amazing chapter handbook chapter to explain and what happens and also institutional settings for Chinese bond market. Highly recommend to read it. And Marlene, are you online?
Yes, I am.
Okay, it's your turn.
So thanks a lot to the organizer for having me, kindly inviting me to this panel, and specifically to E for organizing such a great panel, and also the academic conference. So just to clarify, so I will speak here in the capacity of my academic affiliation and not my affiliation with FINMA. So here I will really focus on the raising global sovereign debt and less on banking and regulatory issues. So when I look into the raising global sovereign debt, then to me it seems there are three major issues, or I would say three gaps that are of particular interest to follow and are important to watch. So I'll first give a very brief overview, and then I'll focus on the first type of gap. The second and third might also be covered by one of the four other panelists. So I think the first gap that is really interesting to follow now after or during this pandemic and the triggered raise in global sovereign debt, the first gap is the gap in local versus foreign currency risk. So having the same sovereign, but one's issuing in local and one's issuing in foreign risk, is obviously, or used to be, not the same risk. And I'll show in a minute a stylized fact, and we have found in a joint work with PIS, and that has showed that actually this gap, so you would expect that local currency should be safer, that this has slowly and steadily decreased. And when we looked into reasons, then we see that actually now, after COVID or during COVID, these driving forces, they have basically reversed. So I think one gap to focus on is this gap between, so what are the driving forces between the local sovereign debt and the foreign sovereign debt? I think that is going to be more important and probably also a little bit more tricky. The second gap is the gap in conditions. I think there is really this stark or this kind of puzzling observation, this gap between the signals of the market versus the signal of the economy. So the economies, the numbers are still quite bleak, or they're just coming in very bleak, and the market, on the other hand, is very upbeat. So I think here, after COVID-19, it's really important to focus, okay, on which signal do we actually rely on, and for what reason, and what is this wedge, what are the reasons, what drives this wedge between market and economic signals. And the third gap that I think is getting more important, looking at global sovereign debt after COVID-19 is credit and the possibility that the gap between sovereign versus corporate could actually narrow. This is because with the increased support of sovereigns, there could be, not in the whole economy, but in specific industries, we could see that it's getting less easier, it's getting more difficult to actually differentiate those two types of these two types of risks. So to start with the first one on currency, so when we look into the same sovereign, one's issuing in foreign currency, one's issuing in local currency, then the literature mostly overwhelmingly looks into the driving forces of foreign currency. And local currency is basically seen as, okay, depend on the same driving forces because it's the same sovereign, but it is safer. And often it is said, well, it is safer because mostly it's just noted that it's safer, it will always be honored because the sovereign can then tax and can inflate away basically this debt. And when we look into how this risk is actually perceived by rating agencies, and rating agencies are important how they define these risks because they define how these risks are then reflected in the balance sheets. So when we look into these ratings, then we see in red the average of local ratings deteriorated from the mid-90s, and the average in blue of the foreign ratings first deteriorated during the Asian crisis and then slowly and steadily increased. But overall, on average, the gap, so for the same sovereign, the gap between local and foreign ratings decreased from previously about 3 to basically 0. So now, or before the pandemic, the rating agencies would see, as long as it's the same sovereign, it is the same risk. And the same can be seen basically in this chart, which is saying the same thing from a little bit different angle. So in the mid-90s, the norm was that when we have the same sovereign, then the local currency would be about 2 notch higher rated, and this basically then the foreign currency debt. And this basically totally reversed. So now the new normal is 0 notch. So now the rating agencies, they do not differentiate. As long as it's the same sovereign, it would be also the same risk. And so usually this would look like this. This is an example from South Korea, that you have in red the local currency being a little bit higher than the foreign currency. So this would be the usual case that we see, and that over time this gap would close. There are a few exceptions, and these are more in, so what we looked into is mostly emerging markets. So there are some exceptions to what I've just said, and particularly the case of Japan is such an exception, where the reverse is true. So where actually the foreign currency rating is higher than the local currency rating. And this might be based on the considerable difference between the external credit metrics and the domestic balance sheet. So that might be also something interesting to look into, how this evolves for the developed markets. And for some, of course, the gap never existed. So who closed that gap, and could it reopen now after COVID-19? Well, what's interesting, what we found is that it's actually not inflation that caused this slow and steady decrease in the gap. So we have no indication of substituting monetization for default risks when inflation is high. So when at some point when inflation is high, then it is as costly that still, even in local currency, you would observe defaults. So what actually caused this gap to close were this major increase in foreign exchange reserves, the development of the local currency bond market, so the lower original Shin, lower global volatility as the third factor. So all those factors would close this gap. And all those driving factors actually reversed during COVID-19. So just looking at these driving factors, I think it would be important that now with this increased sovereign debt and to big part in local currency, I think it would be important to focus more again on these differences and not just to assume that in all cases this would stay the way that it was before the pandemic, and that it would not be differentiated between the different currencies. So the question here basically is whether we will revisit the forgotten history, as Ken Rogoff and Carmen Reinhardt put it. So this would be the first gap to watch, where I would guess that we'll see some changes over time. The second gap that I think is important to monitor in this environment is the gap between what the market signals versus the signals that we get from the economy. And so I've plotted here just a chart from the BIS quarterly review. So as always, an excellent read. And we see that while stocks market and similar for bond markets made up losses since March, this is not at all the case in the real economy. And I think it's really crucial to find out what are really the driving factors behind this. And in whatever in our assessment of the sovereign debt, we need to be very, very cautious on what type of signal we rely our policy recommendations. So one way to look into this gap is there are some new types of explanations or indicators what could explain this gap. Not all, but many are kind of related to sentiment. So here is a very simple one that we've done the COVID risk attitude index, just plain simply counting in Google Trend and Baidu the searches for COVID-19 and Corona. And what we see, it is actually very highly correlated with stock markets. We do the same for bond and CDS, and we see the same thing. So the point here is mostly that we need to really be very careful on what is the impact of sentiment, because sentiment can very quickly reverse, and particularly because with the right sentiment, you can basically finance, it seems, any debt level. So as long as the sentiment is in quote right, it can justify very different debt levels. So I think this gap between market and economic signals is very important to understand and to begin to really be sure that we draw the right policy lessons. The third gap, aside from currency and the conditions, is the credit. So with the increased support of government, the increased support of sovereigns for their corporates, there might be, not here and now, but further down the road, and also not for the full economy, but at least for some of the industry, it might get more and more difficult to differentiate between sovereign and corporate risk. We see here a quite extreme example for different reasons, but ending up in a very stark observation that we see for Chinese, these are non-financial credits. We see that this is starkly tilted to the high ratings. And this is an example of a case where it's not that easy to actually disentangle non-financial corporates from what would be then also the government support in the right circumstances. So this just illustrates for different reasons, but is another illustration of how difficult it can get to disentangle then sovereign from corporate risk. So measures to make sure that we really measure the right thing is, I think, also key in that context. And finally, when we discuss the increase in sovereign debt triggered now by COVID-19, as important as this is, I think at the same time, what we should not forget is that even once we've solved all the challenges and we addressed all the challenges related to the increased debt level triggered by COVID-19, once we have kind of tackled these new challenge, there is still one old challenge left, and the massive one. So these contingent liabilities, so the here represented by the pension guarantees, are much larger than conventional debt, and whatever way we would choose to address then these challenges for the increased sovereign debt due to the COVID-19, we should not forget that there is still this elephant in the room waiting for us to get an answer and to get solved. So overall, to sum up, so I think there are three issues where research topics, I would also say, where it's, to me, it seems very interesting to keep an eye on, even more so than before COVID-19. This is this difference in the currency. So not just only focusing on foreign, but I think to differentiate the different drivers in local currencies and be sure that to disentangle this from foreign currencies is one important gap. Then the conditions, this widening of the gap between market and the economy, so that we are sure that on what type of signal we rely our policy recommendations. And finally, then also this narrowing, potentially narrowing gap between sovereign versus corporate could be an issue that is good to keep an eye on. And I leave it at that.
Okay, thank you very much for Malane's excellent presentations. So she reminded us two very important components. One is so-called currency risk. We learn a lot about the currency mismatch. We learn a lot of Orange Sing story. Now recently in China, we will discuss currency issues because now RMB to dollar, we appreciate needed recently. And think about China as a creditor. So if also lending in dollar, now dollar depreciate. If lending is RMB start to appreciate. So there's a lot of issue in terms of either strong dollar or strong RMB become two major important currency due to the debt work. It's number one currency. Secondly, we are going to discuss very important issues after we learn every speaker because of how to deal with the debt. So second one is the speaker is a fantastic speaker. It's a leading scholar and the policymaker, advisor, and people knows market more than anyone in this room or online. Is a Dr. Professor Haizhou Huang. Haizhou is management committees of CICC, the leading investment corporation in China, and also the famous paper recently wrote with Professor Patrick Bolton, about capital structure of nations, debt or equities, and we are going to learn Haizhou's insights about how to deal with the debt from market or academic perspective. Haizhou, it's your turn.
I prepared a few slides, so let me show some of the slides. Then basically that I think that we can have other panelists, and then we have time for discussion. So hold on. Okay. This is the title of the panel. I think that I want to discuss a few countries, starting with the United States, and then I'm going to move to Europe. Japan is very interesting. Japan has been basically, hitting this rising debt, public debt. Meanwhile, with very low growth rate, with very low inflation for 3 decades. And then I will talk about China and try to share some light about the emerging markets. This slide is about the United States. If we talk about that, I would like to provide a more kind of a comprehensive analysis, i.e., I open the black box and try to understand what kind of debt we're talking about. So here I plot 4 curves representing financial institutions. This is the blue line, households, governments, and non-financial, which means that corporations, non-financial corporations, or real sector. If you really see those 4 lines, you see that from 1990s, U.S. started to have deregulation, and then basically that financial sectors start to leverage up. Is the leverage ratio, which is debt over GDP. GDP is for the whole nation. Went up from 40% to basically 120%, increased 3 times. That's before the Great Financial Crisis. After the Great Financial Crisis, of course, that the financial sector start to deleveraging. The second is about U.S. household. Again, I think that from 1990s to 2008, is the leverage ratio almost went up twice, from roughly close to somewhere around 50% to 100%. Then of course it declined after the 2008 crisis. This is the government debt. U.S. government debt, more or less, before the Great Financial Crisis, maintained at a very healthy level. Somewhere, basically that around 60% of GDP, and then basically that because this quantitative easy, I think that it went up quite substantially, from basically close to 60% to 100%. What's more interesting is the end part, which is of course because of the COVID-19. I think that it looks like that the U.S. Debt to GDP ratio for the U.S. government will go up quite substantially. For basically that for it has a huge jump for basically a year or within next 2 within a year and a half, about 20%. This is of course according to CBO's forecast. Much of the U.S. Basically that debt is financed by the Fed. So in a way that if you really think about the quantitative easy, if you think about the magnitude of QE1, QE2, or QE3, I think that they cannot be comparable to QE4. QE4 jumped, very quickly, and that's since March this year, and that's what's happening. Okay, there are of course there are some other factors that could help U.S. to sustain its its debt financing for quite some time. Number one, of course, that U.S. is also getting into very low interest rate environment. The primary rate, if you think about the Fed fund rate, it basically is 0. If you think about the CPI, of course, the CPI came down substantially. If you think about the 10-year Treasury, 10-year Treasury also came down quite substantially. The blue line is the U.S. real GDP growth rate, and I think that this year, of course, the U.S. is hit hard by the pandemic crisis. Japan was the first country I want to mention that I will talk about Japan later on. Since 1989, Japan basically hit by the crisis. Japan got into a very low interest rate environment, and pretty much like a 0 interest rate, 0 inflation, and zero growth rate. Japan had a lost decade. Then quickly people realized Japan had the second lost decade, and by now Japan had the third lost decade. Its debt to GDP ratio, if you think about the government debt, it went up so much. I think that so really for advanced economies, I think that we really need to study Japan to understand the implications. But here's the United States. US just got into zero interest rate from this year. So in a way that US, number one, I think that will benefit from the very low interest rate environment. Okay, that's the first point. Secondly, of course, that I think that given the role of the dollar, the US dollar, global inflows, will continue to help finance US government debt. I think that the dollar is still the most important reserve currency. I think that and I think that the demand for US dollar as a reserve will remain more or less the same in a way for the foreseeable future. And so that's also going to play a very important role. Let me come to Europe. Okay, this is in a way that the same measurement, four curves, financial institutions, governments, and non-financial institutions and households. If you really if you compare apple to apple in a way, if you compare the leverage ratio of say financial institutions of Europe and compare that with the United States, I think that the leverage ratio of European financial institutions is much higher. It's measured by GDP is about 140%. US hit 120, at 207, 208. Then basically US level came down substantially. If you think about Europe, there's not much deleveraging since the 2008 financial crisis, frankly speaking. Much of the deleveraging happened in the household sector. The household sector, in a way that is at their level, even at the peak of 2007, was much lower than the United States. Remember that the US level was about 100% of GDP. And for Europe, it's about 70% of GDP. Then basically it came down to close to 60, and recently it went up somewhat. US corporate, their level is very low. Measured by GDP is somewhere around 60%. Europe, basically, if you think about European corporate, they are much higher in a way that almost double United States level, 120% or so. And meanwhile, since 2008, not much happening. I.e., the leverage ratio maintained quite high. After 2008, if anything, I think that the government debt level increased a lot. I think that those are a very simple comparison. I think that when I talk about China, I think those comparisons would be more interesting. Okay, but for now, I just want to lay out some facts. Well, I think that since 2008 financial crisis, especially after 2012, the European debt crisis, the growth rate in Europe, if you really think about the real GDP growth rate, came down quite substantially, and the interest rate came down quite substantially, and the inflation came down quite substantially. If we really think about Japan, as I mentioned, I think that for advanced economy for European countries, I think that we should not be so much worried about debt sustainability, because it will continue to be benefit from the very low interest rate environment. Japan is very interesting. I think if you really think about the government, I think Japan is most interesting. Remember that after 1989, since 1989, I think Japan was hit by a crisis. If you really think about a non-financial institution in Japan, and I think that the debt level is very high, but then Japan went through a very meaningful deleveraging process. Over the deleveraging process of the real sector, remember that if you really think about the government debt went up so much. From below 100%, now is 230, 240%. Okay, Japan is still there. The consequence of Japan, to some extent, I think that is that Japan had a very low interest rate environment for 30 years, virtually zero interest rate for 30 years. zero interest rate roughly, a very low growth rate, and very low inflation. And Japan, in a way that it continued, it continued like that. The government continued to issue government bond, and there is also a strong demand from the private sector, from other sector. What happened to Japan? Of course, number one, I think that if you really think about the government position, you also need to think about Japan owns so much asset in overseas. So Japanese overseas asset continue to grow. And here I plot, the blue line is the overseas asset. I think that the red line is the government debt outstanding. So i.e., Japan invests so much outside Japan. Another way to think about that is that the GNP is far bigger than GDP. And meanwhile, that outside Japan, the interest rate is way above zero, at least before this year, right? So in a way that the financial return is much higher. So Japan used the higher financial return from overseas country to basically finance its domestic government bond to some extent, or finance its domestic financial position. And that really helped, okay? Another related reason, because the market understands this. So in a way that you really think about the foreign investors, even if the interest rate of JGB bond is very low, I think that the foreign investors still show a strong interest to hold government bond. So i.e., in the foreseeable future, I'm not terribly worried about the Japanese bond or JGB bond. Okay, I think there will continue to be demand for that. China. I will spend 2 slides talk about China. Well, I plotted the 4 curves again, okay? Government debt, corporate debt, financial sector debt, and also household debt, okay? So really, household debt in a way that, is really, I think that if you really compare the 4 curves, I think that more or less the household debt is very healthy, in a way. However, it also went up in a way quite substantially. Before 2005, household debt to GDP ratio was virtually very, very low, 5%. Okay, 10% in a way. Now basically that is about 55%. Remember, in the US, that level reached 100% at 2007. Remember that in Europe, that number was only 70% in 2007. It came down. China, that level, why is continuing to rise, is only about 60%. If you really think about the non-financial sector, which is a right-hand scale, the non-financial sector, that level is much higher. It's about 170% roughly. Let's keep this in mind. US level is about 60%. European level is about 120%. China level is about 170%. The difference is huge, okay? So the corporate sector in China leverages so much, okay? Of course, this reflects China's financial system structure, i.e., it relies so much on bank financing, okay? The equity market, the capital market is not so developed. I think the root problem is that, okay? Meanwhile, I think that China's corporate very handle in a way that if they really need to grow, they have to borrow a lot from bank or issue a lot of bond. Okay, and that part is quite clear. Government so far so good. Okay, this is basically focus. Well, if you here is basically the non-financial sector. For 4 different economies. Okay, China, US, UK were 5, Japan and Europe. Here, of course, noticeably that if you really think about the leverage problem, I think that in the corporate sector in China is something that we really need to watch for very closely. Okay. Meanwhile, I think that while China continued to enjoy healthy growth, and the interest rate in China also came down somewhat. So for now, I think that I'm not terribly about that. But I think that if you, from the market perspective, also from the government perspective, I think that the high leverage ratio is indeed very serious constraint for China's growth going forward. Emerging market, other emerging market, okay, China is also plot there. So really that if we think about it through the twin deficit perspective, I think that there are a number of economies that are really was watching. Okay, China in that regard is still okay. Okay, in China, but Taiwan, province China, Korea, they are in far better position. But China is not. If you see, if you read this, you see clearly that is still okay. Last slide. If you think about the emerging market, I think that Argentina, Turkey, Hungary, Chile, Poland, and those basically I'll be more careful in a way that if you think about the leverage problems. China is the country that we need to watch for, but I'll be more worried about the other economies. Of course, we have other distinguished panelists in this panel. I look forward to hearing their view, especially Shin and others. Let me stop here.
Okay, thank you, Haizhou. And next speaker is Professor Dr. Jian Wang. Dr. Jian Wang is Associate Dean in Academia for Chinese University Hong Kong, Shenzhen. Also co-director like Jian is Macro Stability and Innovation Center, also at the Shenzhen Financial Institutions. And plus, Dr. Jian Wang used to be economist at Federal Reserve Board, Federal Reserve at Dallas. So Jian, it's your turn.
Okay, thank you, Yi, for the introduction, and also thank my colleague at the Fed, Zhou Hao, for the invitation to attend this panel. Yeah, let me share my screen quickly. Okay. Yeah. Let me first, give a quick review about the comments I want to make at this great panel. I've learned a lot, from Marlene and Haizhou's presentation. Looking forward to other panelists to share their view about the global debt issues, especially after the pandemic. And I want to mention actually for this debt issue, both from the governments and from corporate debt, that happened already after 2008. The COVID-19 pandemic just made the situation much worse than before. It's not something totally new, but I think this is a very timely conference to discuss this very important issue for the global economy. There are many factors, behind the rising global debts. As Marlene mentioned in her presentation, it's very important, for the policymakers and researchers to identify these factors. These factors will have very long-lasting effect on the global economy. For example, of course, one reason is the fiscal stimulus, passed by different countries following the crisis, both for the 2008 financial crisis and also the pandemic recently. In addition, the very slow economic growth after 2008 is also a very important factor. I will show you some charts later on. To some extent, I think many countries, particularly advanced economies such as the US, lost some of the fiscal discipline the country followed before. It's also a very, I think, worrisome, signal to the global economy. In addition, I will use the US. This is particularly, for the US economy. Many companies use these leveraged stock buybacks in a low interest rate environments. That also contribute to, fast rising corporate, debt in the US. This raises at least two more important, policy issues in my opinion. I think, first, how to, solve or deal with these issues going forward. Whether, we should, allow higher inflation, or it's one of the a potential solution for the problem we are facing right now. In addition, this actually what happening recently, especially the disconnection between financial markets and the real economy, as Marlene mentioned in her presentation, also makes me start to think whether monetary policy or fiscal policy has played an important role in this disconnection, whether this will create some problem like I said bubbles, especially when the income or wealth inequality is very high globally. So these are the layout for my presentation. I will try to finish them within 10 minutes. First, if we look at the government debt as percentage of GDP, I just give you some example for emerging for advanced economy, as Hydro also show in his presentation. This debt to GDP ratio increase dramatically for many governments in response to the 2008 financial crisis, and the situation become much worse, especially in the U.S. after the after recent pandemic. We have seen the U.S. budget balance or U.S. fiscal deficits as just plunged this year. This situation I'm not expecting to be substantially improved in at least in next year. So we're expecting to see the total government debt to GDP ratio continue to increase rapidly this year and next year. This is a very serious issue in the U.S. and also as Hydro and Martin show in their slides, also a big issue for other advanced economies, also emerging markets. And this is kind of related to the very low economic growth globally. In this chart, I showed the labor productivity growth rates in the U.S. But if we look at data in other countries, we observe a similar pattern. If we look at the labor productivity growth rate, this is measured by the output per hour of labor. Before the crisis, it was around like 2.5%. But after 2008, financial crisis, that almost decreased half into 1.4%. But if you look at the more recent data, because after the 2008 financial crisis, due to the fiscal stimulus and other type of factors, the economy just rebound quickly in 2009, but start to decrease again after 2010. If you look at the data after 2010, the labor productivity growth rate is only around like 0.9%. That's only a little bit, more than 1/3 of the growth rate before. We have seen some, encouraging, signs last year in 2019, but because of the pandemic, pandemic, we are expecting, this trend will, come back again. So this is a, kind of long-lasting issue has been troubling the U.S. economy and also global economy for quite a long period of time. Due to the slow economic recovery, it's difficult for the government to raise enough revenue and also cut their stimulus packages. So that's very important factors for what we have seen today for the very high government debt. But if you look at the U.S. data, still it's quite disappointing. Like the U.S. government didn't decrease the government expenditure after 2017. And in this chart, I showed the government budget as percentage of GDP and also the unemployment rates in the U.S. These two series of data are usually positive correlated. This is reasonable. When the economy is bad, when the unemployment rate is high. the governments will run higher, deficits. But when economy start to recover, we are expecting the government's, expenditure going down, and try to, impose some discipline on their expenditures. But in 2017 and 18, even if the U.S. economy is in a relatively good shape, when the unemployment rate is at its historical low level, but the government passed a new round of stimulus package, that make the fiscal deficits even widen during this period of time. And over the pandemic, this situation is, I think, it's quite reasonable, for the government to try to help the economy, but looks like there's a much less resistance, compared to previous, scenarios. Looks like, many countries are right now kind of used to this, big spendings from the governments. And so as a result, I'm quite pessimistic about the future, whether the government has enough, discipline or other, tools in order to reduce their expenditure, especially face the current political environments. And we were just talking about the government debt, but if you look at the corporate debts, that's something similar in the U.S. And in this chart, I showed the size of corporate debts in different rating in the U.S. We see after 2008 that increase also very quickly, especially for the rating at the lower, like a A or BBB rating debts, corporate debt increase very quickly. And as a percentage of GDP, this is similar pattern. If we see this compared with the previous business cycles, right now the ratio of non-financial firms debt, securities and loans over GDP is much higher, compared to previous business cycles. As Professor Wang Haizhong mentioned, if we compare across country, maybe U.S. is not the worst case. But still, if we just look at the over different time series, still right now it's a very high level. But this is quite confusing. If you look at the real investment in the U.S. from the private sector, it's quite weak after 2000, especially after 2016. But why the corporate raise so much money? If they do not have some real projects to invest. One reason is the stock buybacks. If you look at the stock buybacks in the last 10 years, that is much higher compared to the historical level. I did some simple, just like a calculation. This non-financial these bigger companies for their stock buybacks, it's about like a $5 trillion US. If you look at how much debts they issued or bonds they issued in the last 10 years, it's about the same. It's about the same amount. I'm not saying like they use all of this money to buy back their stocks, but this definitely this low interest rates environment contribute to this leveraged stock buybacks. And also in 2018, following the tax cut in the U.S., they didn't use the money from the government to put into some real investment to create some more jobs. Instead, they just use the money to buy back their stocks. So it's to some extent these policies are a failure. They didn't achieve their goal, try to stimulate the real economy. So going forward, looks like we're kind of in a dilemma. The economy continue to grow at very low rates, and if we pass the low interest rate monetary policy and use tax cut, this type of fiscal policy, looks like they are not working. how to solve this issue and how to avoid this problem created by the high government debts. Maybe one, I think in just last week the Federal Reserve just changed one of the policy is to target the average inflation. The market interpret that as in the future the Federal Reserve will allow the interest rate to be higher than its target level for a quite relatively long period of time to stimulate the economy. So whether the high inflation target is especially in a low growth environment is reasonable way to some extent, that's reasonable. Actually, after 2008 financial crisis, when I was still working at the Dallas Fed, there was already some discussion about like allow the interest rate to be higher. In that way, we have more cushion for monetary policy. We don't have to hit the lower zero bound so frequently. But there are several concerns at that moment. One is like people may interpret this as we try to lower the financing cost for government debts. So especially right now, if the government debt issue is even more serious than before, if we allow the interest rate, allow the inflation rate to be relatively higher, I think a lot of people will interpret this as the Federal Reserve or other central banks try to monetarize the government debts. More importantly, even if we allow the inflation rate to be higher, whether we can achieve this goal, it's difficult. It's not that easy. Just like Bank of Japan has been trying to do this for 3 decades, as Professor mentioned. If we promise to have higher inflation rate, but we couldn't achieve this goal, that would definitely damage the central bank's reputation. Also, there are many associated risks. For example, if in the future, if inflation rate really go higher, and in particular, if it go much higher than we have expected, that will be a really bizarre situation for the central bank. So this is not like a easy situation to handle. And the second thing I was thinking about, also as Marlene mentioned, there's a big disconnection between the ISI prices. We have seen the U.S. stock market, drop early this year, but rebound very quickly, and also with the rising debt from both government and private sector, which is not reflecting the weakness of economic fundamentals. This disconnection between the real economy and the financial market is really, I think it's something we should really worry about. Whether this is this situation is caused to some extent caused by the monetary policy or physical policy, I think it's very important. It's a very urgent issue for us to figure out and how to solve this issue. Actually, after 2008 financial crisis, many countries passed this macro-prudential policy, try to avoid the ISI price bubbles, try to stabilize the global financial markets. But the current situation really make me wondering if such policies are really working or could have made the situation even worse than before. Okay, I will stop here. Thank you so much for the invitation. Looking forward to hear other panelists' opinions.
Okay, thank you. Professor Hao Zhou is Associate Dean here and also Vice President of the Center for Policy in Tsinghua University PBC School of Finance, and a former economist, senior economist, at the Federal Reserve Board. Okay, Professor Hao Zhou, it's your turn.
So, all the previous speakers mostly focus on the global debt, global policy comparisons, and I will deviate from Yongxin and others to zero in more on China's policy. So it's just making a good contrast. But in a way, it is also in Yongxin's spectrum that representative of emerging country versus representative of advanced country like China relative US, what makes a difference. So that's why he pointed out the policy looks different. In China, I would coin it particularly as structural policy versus quantitative easing or gigantic fiscal stimulus. So this is contrast I want to show at the end of this panel session. So this is a picture which you can tell 100 stories. You can one slides go on for 1 hour. So I don't want to give that many slides. So when the COVID-19 pandemic strikes all the country affected, but China is the most heaviest hit. So the first quarter GDP is 10% in a quarter-to-quarter basis, 6.8% to annual, whatever the other way around. So what will happen to the recovery process depending on what kind of a fiscal monetary policy mix you want to adopt. Next slide, please. This tells a dramatic comparison to the first quarter. So in contrast to the 10% GDP growth, the second quarter bounced back positive 10%. If you are reading economic data from July to September, you know that the export is skyrocketing to 10%. Real estate is red hot. Retail sales turns positive since this January. You can conclude the third quarter should be significantly stronger than the second quarter on an annual basis, at least on an annual basis. Will other countries get into the recovery as fast as China, just 1 quarter, then bounce back? I think most analysts says no. US Federal Reserve just finished a 2-day meeting. So the policy announcement is that this zero interest rate will last until 2023. So another 3 years. That tells us the economy is not recovering strongly. It's maybe recovering, but not as much as we want. So likely case, this contrast of China with other most advanced countries will stay the similar pattern that although the first into the recession, it will be first comes out. Maybe other countries will not as quickly as this. So what drives this difference? I think this is all my slides about. Next one, actually. So in May, after, in China, within China, after severe policy discussions and the debate, I'm even quarreling with my colleague, like Jian Dong. He said China should adopt, like a 20 trillion deficit or whatever. Should flooding the market with liquidity by the central bank in order to rescue the economy. So I argue that's a wrong policy. What China should adopt is moderate stimulus policy with a structural focus. So to save time, I'm going to just list what I mean structural. It includes fiscal policy, monetary policy, finally the debt policy. That corresponds to what Yongxin had said. The sovereign debt versus local government debt. That's also anchoring what Yi had presented in China. This local government debt play a much bigger role than the sovereign debt. So what do I mean this fiscal policy, the structural nature of fiscal policy? Let me just give you the number. In US, this fiscal stimulus is 2 to 3 trillion. Depends whether the Congress will approve the last batch. So it's a 3 trillion US dollars. In China, how big is the fiscal stimulus? It's below 3% prior to the COVID-19 every year. Only officially lifted to what? Anybody remember? 3.6%. It's a National Congress just this May said it's only allowed to 3.6%. So there's very moderate fiscal stimulus. The quantity is small, but the structure is it targeted to firms. If you remember, in US, most is given to the individuals, households, debt relief, but it's targeted for firm. That's called the structural nature, I would call it, this fiscal stimulus, small size, but it targeted to the sector which is suitable for the growth of the medium income country. In US, you have this consumption is 70, 80%. Of course, I should stimulate the residents. In China, consumption is less than 40, 50%. It's a medium income country. That's why firms, constructions, real estate should receive most of the stimulus. Then the second notion of structural policy is the monetary policy. There's no zero interest rate. It's only, lower like 30 basis points. That's through the open market operations. But what it enhances is this so-called structural PSL, pledged, whatever, supplementary lending. If the banks lend to small, medium-sized bank, you can do the repo, etc. So that started before this COVID-19 crisis, but dramatically, doubled, quadrupled, or even 10 times larger in central banks' open market operation. So this is continuing this, but the interest stay like 3% or 2.5%. So that's the second notion of structural policy. I think the last one is most important one, and what this conference and panel is about. In China, the treasury, I think Yongxin shows it's a very small, the treasury debt, sovereign debt is very small, relatively small. And it's only like 28 trillion in Chinese currency. Okay, you know how large is the local government debt? By estimates, it's 30 to 60 trillion, depends whether you include those commitments or guarantees, but net is about 30 trillion also. And they are increasing during this crisis. So one example, to save some time, one example is the stimulus in national debt, nothing. But in the special purpose local government debt, is 2 to 3 trillion. If you remember what the State Council had issued, this year's uploaded this, and they are used for what purpose? Not residence subsidy, but given to infrastructure, highway, and the bank capital injections. Those are closer to the productive capital formations. The national debt, national deficit, and the projects approved by Department of Finance is far away in distance to the productive capital formations, which closer to the entrepreneurs is actually the local government debt, local government expenditures. So I'm going to skip what I had prepared most. I will leave the rest of the time for discussions if we need it. But my conclusion is that's a May 4th review article. That's a prediction saying China will bounce back in the second quarter. And I'm going to make an even bigger prediction, say the third quarter could, on an annual basis, the GDP growth in the second quarter is 3.2%. Third quarter would be much better than the 3.6%, based on monthly data release we have observed. Okay, I'll stop here.
Professor Zhou, I have a question just regarding to China's monetary policy and fiscal policy stimulus. So if we look at the last year's China's data, the GDP growth is about 6%, while the M2 growth is about 8.23%. But in the first half year of this year, so the GDP growth is close to zero, while the M2 growth has already reached to 12.2%, something like that. So it looks like Chinese government has already used the monetary policy to sort of stimulate the economy. Do you sort of worry about, yesterday once more sort of a situation, like last time after 2008, we do see the economy, bounce back, but we see the overcapacity issues. We see the leverage goes up. We see the inflation. But do you think this time we're still gonna see something like that, or we're gonna learn something to avoid the situation like that? Thank you.
Thank you, Jin Fan. Actually, that's a great question. So let me give you answers and explain a little bit. I'm less worried about that than 2008 because this time the stimulus, the package, the scale relative to GDP of the economy, and the way they are funded those projects through a decentralized way, through local government, rather than central government assign this huge project, making me less worried. But little bit of inflation is the best thing you can hope for. As Yuanxin said, globally, there's no inflation that really worries everyone, but slightly inflation as a monetary stimulus helping is actually moderately welcome at this time, I think.
Okay, now we open to the floor, or among the panel speakers, you can ask each other the questions. Any question from online, from Zoom, or from the panel speakers among them?
Well, maybe if I may ask something, Yoon. So thanks a lot, as always. Great presentation. So you really carved out extremely nicely. So the importance of foreign ownership. So I mean, it seems that overall original sin has been largely overcome. So it's possible to issue in local currency. But it's not just matters that you can issue in local currencies, but to whom. So and that these are foreigners pick up these local currencies. So in which way? I mean, looking at the case of China, I think it's still around 5%, so extremely low. So if kind of this is kind of the way to go to kind of try to help to insulate the impact. So to increase these foreign ownership, or to diversify this. So what's your what's your take? I mean, is this something that's gonna take a decade or two? So if this is really the key to this question, whether they can insulate themselves or not. So what would in your view be the trajectory, and in which way could this be or should be supported, that there is some, I mean, there are some automatic mechanisms. There is this autopilot, so that through the global bond market indices, there is some kind of, by autopilot, you would increase the foreign ownership. I would be very interested to hear, so how quickly and what would be the conditions for this key parameter foreign ownership to change.
So E, shall I go ahead and answer?
Yes, please. Then
Yes.
Alexander Swoboda next.
Okay. I think that's a very good question. One not very helpful answer is to say that every emerging market needs to deepen its domestic currency investor base, its domestic investor base, like through the National Pension Fund, through life insurance companies. So those are the natural holders of government bonds that they can use to hedge their own liabilities. I think another way, which I think is probably closer to hand, because I think the first answer is not very helpful, because it's like saying it's like telling an emerging market you should not be an emerging market, you should be an advanced economy. So that's not a very helpful piece of advice. On the other hand, I think a very much more direct way that one can reduce the vulnerabilities is to encourage more investors who enter the market on a hedged basis. Now, on a currency hedged basis. We know that among the advanced economies, for example, for Japanese or European investors who invest in US dollar securities, they would enter the US dollar securities market on a hedged basis, which is to say, sorry, it's another phone call, which is to say you take a currency swap and you extinguish the currency exposure at the time that you are entering. Now, what's still not the case for emerging market sovereign bonds is that investors enter on a currency hedged basis. And there are two issues for this. One is the size of the derivatives market itself. It's not a very deep market. Typically, investors would use, for example, the non-derivable forward market for ex-post hedging rather than ex-ante hedging. In other words, it's another way of selling your bonds without really selling your bonds. On the other hand, if you can encourage greater hedging, and here monetary policy may also be an important element, because hedging typically takes place by rolling over short-term contracts. So if you're selling 5 to 10 year sovereign bonds, but your short rate is very low, then as a first approximation, the slope of the yield curve is an indication of how cheap that hedging is. So if you have a very low short rate, but you have a very high long rate, then it's easier and more cost-effective for foreign investors to enter on an ex-ante hedged basis. So in fact, monetary policy also has a role to play. And I think this is something that we know already from advanced economy sovereign bond markets, that the slope of the yield curve is very important in the degree to which you have portfolio flows across countries. But the same principle would also apply for emerging markets. So to reiterate, what I would say is, first of all, there's a long-term strategy. You need to build your domestic investor base. Secondly, there may be shorter-term strategies to encourage the greater use of ex-ante hedging.
May I just one follow-up? I don't want to, so someone with the hedging, someone still needs to take up that risk. So it still will be not out of the system. So it will be distant. So key would then be in these hedging strategies that where this risk flows. So where hopefully, so then again, financial system will be very, very key, that it is not condensed in just one particular bank or in just one particular banking system. So
yeah.
So that would be.
We know that there are imbalances in the global banking system precisely because of these asymmetric hedging needs. So this is why during a period of risk off, we see the dollar strengthen, and the stronger dollar is associated with the departure of the exchange rate and interest rates from covered interest parity. So we know that the deviation from covered interest parity is a function of the dollar stress. But that is a feature of the global banking system that we are very familiar with. And this is why for example, in the Swiss franc that you're very familiar with, or the yen, the dollar shortages come because of the hedging need of the long-term investors.
Thanks.
Great. Do I answer questions? Any questions? Okay, Professor Alessandro Swoboda from Switzerland.
Okay, this is something that came to mind listening to Hao. The idea of structural fiscal policy and so on, and implications for bond markets, I find intriguing. And one example is what's happening in the United States, where there is a lot of worry about the local and state budgets and the consequences perhaps for their borrowing needs. I wonder how one would cope with those issues and what the international comparisons would be on that subject.
I think that's probably a question for Haijiu.
Is that a question for me or is that a question for Hao?
I think for both.
Okay, maybe Hao you start and then I will provide some comments later on.
Okay. So I give a two-tiered answer. So from economics perspective, I would definitely say the U.S. should approve some assistance or bailout for local government. But my understanding of the U.S. Constitution is it's a federation system to intentionally separate this federal budget and the local government. So it's intentionally not to let it entangle together. So whether it is needed to be somehow get around this time, I don't know for sure. So that's why I understand this is from economics. This is definitely yes. I would say yes. Haijiu.
I want to provide two comments, not necessarily direct answer to Alexander's very important question. Number one, I think that Hao made a very good point. I think that Hao's sound economic principle probably would apply to normal time. I think that in a very difficult time, or in a very difficult time that we see once a century, or maybe once every 150 years, maybe we need to find another solution. I think that if we really look at the U.S. history, I think that remember that from the original 13 colonies, all original 13 colonies for some reason went bust. Okay, so it really was the James Hamilton that really through Federal Reserve, through Federal Act, the federal government issue bond basically bail out all the failed colonies, and that built up the foundation for an integrated domestic market, and that actually in the end strengthens the dollar, or strengthens the role of dollar in the world. So I think that in a way that whether the government needs to take, or should to take such a dramatic action, I would think that we need to think about what are the alternatives. If the state failed, the economy will be stagnant or into depression for a long time. I think that the federal government should really bail them out. I think there's no question about that. It's basically that is the choice of between two evils in a way that, of course, you also need to think about the long-term consequence, i.e., the moral hazard problem. I think that the sound economic principle that I think how it always exercises with that apply to normal time. In the extremely difficult time, I think that we need to think out of the box, and we really need to save the real economy. So I would think that for the U.S. government, I would support the U.S. government. Of course, that I have no voting right here, but I would think the U.S. government should do something like this. Related to this, I think that the second point is that if you think about the money creation in the United States after March of this year is very interesting. M2 growth in the US reached 20% per annum this year. Very much is through the US Treasury printing checks to households. That's how I already talked about that. So much of the money growth in the US this year is not really through the banking system, through credit expansion, through borrowers, lenders. Instead, the federal government already pay out households through printing checks. Why not just the federal government printing checks pay out states? So I think that that's the right thing to do.
Okay, thank you very much, Haizhou and Professor Hao Zhou. And I saw Ugo Panisas here. Ugo, do you want to ask questions? Ugo just left, or he just raised a hand? Okay, let's wait for Ugo. Besides, let me ask one more question. So everyone talk about difference between China and US. US gives check to the household. China give mainly financial support to the small medium firms through debt relief or extension for maturities. So what should we think of a deeper this approach how to deal with the debt? Can we have this kind of a swap? Haizhou write a lot about this swap between debt and equities, like a COCO contract to all this kind of small medium firm corporate sectors. So I would learn from all the speakers among the panels. What do you think? What's your insight about the swap between debt to equities? Thank you.
Should I start?
Yes, please.
I think that while the economy is hit by a very difficult time, I think that in a way that the economy typically will face a huge debt leverage issue, debt overhang problem. In a way that I think that I already plot, the debt to GDP ratio of real sector in China. I think that the leverage ratio is very high, 170% of GDP. In Europe, 120%. In US, 60%. I think that I'm not worried about the US corporate debt level at all. Really, if you really think about that, of course, you will see some corporate will face some difficulty, and some corporate will need to file bankruptcy or will be, will go bankrupt. But in aggregate, I don't think the US corporate is facing any serious difficulty. Not at all, at least from market perspective. For Europe, I think they're also quite healthy in a way because they are in a very low interest rate environment. And if they pay their interest rate, at least they can play the game for quite some time. In case of China, I think that really is a bit more difficult in a way. Of course, that one way to solve this problem, or theoretically, is to grow out of the problem. If China can continue to maintain at a healthy growth rate, and then of course that they can grow out of the problem. But I think that I think that another way that China should deal with it is to come out with some kind of master plan to do a nationwide debt equity swap. But for that to work, of course, that in a way that China needs to support the economic growth at a decent level, and then need to develop its capital market, especially equity market. And I think that in a way that if the equity market is not so developed and actually raising equity capital is very difficult, you really couldn't do this debt to equity swap. So I think that China has been pushing, in terms of policymakers, in terms of the regulation for deleveraging, nationwide deleveraging. I think that China has made some progress, but I think that probably we need to think this problem more systematically, through debt to equity swap. In the 90s, China actually went through this in a way that, especially for SOEs, for the banking sector, it went very well. The problem is that maybe every 20, 30 years or so, China needs to do another round. I think this is a very important question that E has asked, and we need to really think about how to solve this problem. This is a very important problem. BIS has, under Shin's leadership, has flexed this problem consistently, persistently for quite some time. The IMF also raised this question. The Chinese government is aware of this problem. So that's why in the last few years, the government is really pushing for deleveraging. But I think that, yes, it made some progress before this year. But this year, of course, because of the COVID-19, I think that the leverage ratio actually went up. I think that it's time for us to think something probably, from the first principle of economics, of course, solid principle, and think about how we structure this debt to equity swap. Let me stop there.
Haijo, let me chase on that question. So the China's debt issue, as you show, meaning this non-financial corporate sector, is it mainly SOEs or non-SOE firm? I think the debt or the bond or the issuance, SOE has an advantage in the markets. I'm guessing the majority proportion should belong to the SOEs. I'm guessing just that.
Over the last few years, if you think about the leverage ratio SOEs, I think that the SOEs leverage ratio went up. The private sector corporates, they are forced to do deleveraging. So I think that not necessarily by choice, they are forced to take that route.
Professor Shin?
I think this is a very important issue, Yi, and it's very appropriate that we discuss it. This has been a very unusual shock. I think in the initial period, we had the hope that if we just keep the economy on suspended animation, we can just awake from the shock and then resume life as normal. I think what we have learned is that this is going to be quite a persistent shock, and the global economy has suffered quite a slow, quite a sharp downturn. Now, monetary policy has been extremely accommodative, appropriately, and we have managed to navigate the liquidity phase of the crisis. But as we go into the longer phase of the slowdown of the real economy, we will transition from the liquidity phase to the solvency phase. And the issue is, how do you manage the solvency? How do you manage the restructuring and the insolvencies that will be coming down the line? Now, in the textbooks, we know and we learn about the priority of claims, debt and equity, and we can think of a very ingenious financial claims that will have aid in the restructuring of firms. Of course, those insights will be very important, but because of the widespread nature of the shock and because of the global nature of the shock, we cannot neglect the macro aspects. So if we were to go into a very sharp restructuring and sorting out unviable firms from viable firms in a very big way right now, this will have a huge macro implication. And because the pandemic has affected the services sector particularly strongly, there will be very big implications for unemployment and the labor market. So this goes back to my earlier point, which is that fiscal policy has been a very important piece of the puzzle, because this is the one policy tool which can help to cushion the shock and to maintain aggregate demand in the face of the pandemic. Now, the really big question will be, when do you start to embark on the restructuring of the unviable firms? Because that will be inevitable. We will inevitably come to a point where we need to restructure. The difficulty here is that if you do it in a very far-reaching way, you will weaken the macroeconomy. So we have a very difficult balancing act. How long should you maintain fiscal support, risking the perpetuation of zombie firms, of unviable firms, which will undermine resource allocation, while at the same time making sure that the macroeconomy doesn't suffer such a big shock that there will be huge spillovers. I think here we need to be drawing lessons from all the different fields. And I think one field that is particularly promising, especially in the context of China, is the use of data that may come from the big techs. So we know that WeChat Pay, Alipay have very detailed network information that can help in the sorting of viable and non-viable firms. We will inevitably have to face some inefficiency. There will, of course, be at the margin, there will be fraud. They will be providing support to firms that are non-viable. But of course, this does not mean that you should just have a blanket policy that will undermine healthy firms as well. So one thing that I would urge our colleagues in China to think about is, how do you use the information that could come from big tech credit, and in particular the various techniques for credit evaluation, to help policymakers to engage in the restructuring going forward. Now, let me advertise one working paper that Leonardo Gambacorta wrote with Yiping Huang and Han Chu. And as you know, there's been a joint project with Ant Financial looking at the use of the detailed credit data. And one of the interesting findings is that if you are able to use the detailed network information from big tech credit, you can actually make the granting of credit less pro-cyclical and less dependent on property collateral. So I think this is a really intriguing avenue for thinking about how do we provide additional help to the fiscal authorities and also to the restructuring authorities and the financial supervisors, who are ultimately going to bear the burden of the restructuring, to do the restructuring in a more rational way, in a way that's going to cause less macroeconomic damage.
Thank you very much, President Shin. I saw Ugo's try to ask a question. Ugo, it's your turn.
Yeah, thank you, Yi. And in a perfect application of Murphy's Law, I lost my internet connection in the middle of the panel. So now I'm standing on my balcony in order to have an internet connection. But so first of all, before raising a comment, I just want to thank Yi and Linju for organizing this Beijing leg of DEFCON. It was really fantastic. And my co-organizer, Anna Gelper, asked me to thank you. It's 6, it's in the middle of the night in DC, so I don't know if she's logged in. But I wanted to add a comment to something that Yoon was saying when he was talking about the trade-off between maintaining fiscal support and the risk of generating more distortion in the economies. there is another layer of this trade-off that it's at the fiscal, at the government that sustainability level, because many governments still have ample fiscal space, and especially as it was mentioned before by Arzu, interest rate is 0, but not all governments have fiscal space. So the other trade-off involved in maintaining this fiscal support is that there might be a sovereign debt crisis down the road. And in fact, yesterday, Lee Buchheit says that he would not be surprised to have a wave of multiple default in frontier and emerging market countries coming all at the same time, which would put considerable strain also on the international system, because when we're seeing it's complicated enough to deal with 2 or 3 countries defaulting. If you're going to have like 12 defaulting at the same time, we could have a replay of the debt crisis of the 80s. So more than a question, was a comment on adding this further layer of complications.
Okay, Haozhou, you have any comments or remarks? I'm done. Okay, thank you very much. And I think in the last very important policy recommendation by Professor Yongxin is try to use the digital technology to help our policymaker to make precisely more active, more better policies to save our pandemic and save our company, save our household, save our countries, also save all the world. So finally, let me thank Hugo for initiative to invite us to organize this conference, and also we thank all the people here to help us to make things happen, especially for Tsinghua University PPC School of Finance, and thanks all the staff here. Thank you very much, and stay safe and stay well.
Thank you.
Thanks.